Every day, the market hits a new all-time high. The best companies in the world are racing higher, refusing to go on sale. But no matter the market, it is key to continue buying. Sitting on the sidelines is the biggest opportunity cost there is. But what is actually worth it? Has a wide economic moat and strong future growth potential. On this list are 3 dividend growth stocks and 2 pure growth stocks. These businesses have wide economic moats and long future runways for growth. Each is a leader in their industry. Each is trading at what I believe is a fair price. Before revealing this list, please like and share this video. Also, subscribe while you're here. It only takes a second and it really helps this channel spread content about all the quality businesses in the market. Sometimes a stock can be trading at a 52-week high or even an all-time high and still be undervalued. The stock market presents many mirages just like this. 2 stocks on this list fall into this bucket. They seem expensive, but once you understand their business and growth potential, you cannot pass these up. The other 3 have been stubbornly bouncing around their current prices and refuse to go higher. There's value here the market just doesn't recognize yet. We'll get into each business's economic moat, growth potential, and what I believe is their current price target. So without further ado, let's get into these 5 incredible businesses. First on our list, we have MSCI, ticker MSCI. You can see they closed out the day at a $486.32 share price. This is one of those stocks that's been bouncing around now for about a year. In the last year, they have returned almost 2.5%. However, you can see they have excellent growth here over the last 10 years or so. Their revenue, gross profit, and operating income have all risen very consistently. Their earnings per share also rising quite consistently. In fact, their earnings per share annualized 10-year growth rate is at 22.9%. Looking further, we can see they have an operating cash flow growth rate at over 14% and a free cash flow growth rate over 15%. MSCI is a very capital light business. You can see that down here on the cash flow chart. They generate a lot of operating cash, but they have barely any capital expenditure. This means there's a lot of extra free cash flow over for investors. And what do they do with that free cash flow? Well, they buy shares back at a very nice clip, 4% per year over the last 10 years, and they pay out a dividend to investors. In the last 5 years, it has grown at 23.5%. And just last quarter, they increased their dividend by 15%. MSCI is an industry leader in the indexing business. They have about a 20% market share along with S&P Global in US indexing, but around the world, they have close to a 50% market share. I've done multiple videos describing MSCI and their economic moat, and I will link them below in the description. On top of collecting a fee for their indexes that they license out to portfolio managers who use them as benchmarks, they also collect asset fees for the funds they manage. Due to the very low overhead of this type of business, you can see their margins are phenomenal. Over the last 10 years, they've averaged almost 80% in gross margin and 48% in operating margin. And that margin has only increased, going up to 54% operating margin last year and an 82% gross margin last year. You can see that trend here on the charts below, and as more money flows into indexes in general, MSCI will continue to reap these rewards. They have a free cash flow margin just last year of 45%. Again, that should only rise over time. Currently, MSCI, based on my scoring system, has a growth score of 3.4 over the last 5 years and an astonishing economic moat score of 4.55, leading to an overall score of 3.83. We want to see a score of anywhere above 3. That typically leads to higher than 10% returns, and we can see that MSCI over the last 5 years has given us a 16% compounded annual return. My base case discounted cash flow for MSCI is at about $452.84. And our bull case is at $619.20. The bull case assumes almost 12% annual growth in revenue over the next 10 years and about a 50% free cash flow margin by year 10. This is achievable by MSCI if they achieve their stated current targets for their ESG segment and their indexing segment over the next 10 years. That's roughly growth in revenue in the 10 to 15% range for those two segments. But where they really shine is in their dividend. I mentioned their great dividend growth over the last 9 years or so. Well, assuming they continue to grow their dividend at only about 13% per year, that gives us a dividend discount of $781.45. Growing their dividend at 15% per year, or what they just grew it at last year, that's a dividend discount of $892.38. This is a very strong dividend growth stock. And on their exit multiple, I have them at $543.52. At roughly a 10% margin of safety, their current buy price is at $511.83. At a 20% margin of safety, that's at $452.96. I like to start adding MSCI when they get below the $490-ish mark. And right now, at $486, I think they are a pretty reasonable buy. If you do want that little bit more safety there, then waiting till they fall a little bit more, even below $470, you get a little bit more margin of safety. But I think right now, up to about $500, $505, they are a very good buy with excellent growth prospects for the long term. The second stock on our list today is UnitedHealth Group, ticker UNH. They closed the day at $482.59. They've had a bit of struggles this year. You can see they're down over 8% on the year. Their struggles have been both internal and external. Internally, they've faced a cybersecurity attack along with a divestiture that lost them a little bit of money. Externally, they're facing a probe from the Department of Justice, and they've been dragged down by the broader healthcare sector in general. They also took a bit of a hit with less than expected Medicare pricing for 2025. I discussed all this in multiple videos, which are linked below. But despite all that, you can see UnitedHealth is just a very steady grower. You can see since 5 years ago, their revenue growth has been accelerating along with their gross profit growth. They've also increased their earnings per share, and like MSCI, they're an excellent dividend payer. They just increased their dividend by 13.9%, and another very capital light business. Look at this operating cash down here compared to what their CapEx is. This leaves a lot of free cash flow and a lot of room to grow that dividend in the future. Their trailing 12 cash flow has come down a bit. That is due to the aforementioned problems of the cyber attack and the divestiture. But those should be one-time events, and we should see their free cash flow growth to accelerate here in the short term. They have a very wide economic moat in that they are the largest healthcare provider in the country. This gives them a lot of pricing power in the market, also explained in my videos. Couple that with their very fast growing Optum Health subsidiary, which is the provider arm of UnitedHealth, along with a very robust data analytics segment. They should continue to see 10% plus growth well into the future. UnitedHealth has a growth score of 3 and an economic moat score of 3.5, giving us a total score of 3.2. Over the last 5 years, this has led to a return of 13.8% per year. Like I said, UnitedHealth is off to a rough start this year, and their growth potential has lagged a little bit, but we should see a much smoother second half of the year. Their free cash flow should increase, and they should get back to very strong growth in the healthcare segment. Based on my discounted cash flow analysis, my base price for UnitedHealth is at $659.23, and I have a bull price of $822.68. This assumes free cash flow growth over the next 10 years on a base case of only 6% per year, and free cash flow growth of 8.6% per year if they hit their bull targets. This is a company that just generates so much additional free cash flow that's really going to benefit and reward shareholders for the long term. And like MSCI, with that strong dividend, they have a strong dividend discount price, $640.44 for the base case and $775.09 for the bull case. This assumes they continue their current dividend growth of about 12.5% to 13% over the next few years. Their price is dragged down a little bit by their competition. The rest of the healthcare market is reeling right now. My exit multiple is at $332.11. This is based on a PE multiple of 20 for the rest of the market, whereas right now, UnitedHealth Group has a 29.5 PE. They have strong future growth projections, however. Their forward PE is 18, well below their 5-year average and a little bit below their 10-year average. At a 10% margin of safety, or a forward PE of 19.6, that's a buy price of $520.02. At a 20% margin of safety, that's $462.24. UnitedHealth has been bouncing around this range now for the last couple months. And whenever it dips below about $510, I like to start buying more of it. So at $482, I think it's still a very fair price, and I'll probably continue buying it up to about $500 or so. The third company on this list and the final dividend payer is Google, ticker GOOGL. Closing today out at $179.63. Google is a powerhouse. They are by far the industry leader in search, which makes Google an advertising business, actually. They derive about 75% of their income from ads. They have the most watched streaming service in YouTube, and they have a growing and robust cloud services business in Google Cloud Platform. They are third in that market, and they don't need to be number one, however, to still reap the rewards of the cloud services segment. You can see their revenue, gross profit, and operating income has risen every single year over the last 10 years, along with their operating and free cash flow. Google has been making large capital investments into both their cloud services and AI, but a lot of their heavy investment is now behind them, and we see these investments start paying off in the next couple of years, resulting in much better free cash flow. You can see year to date, they're up 28.5%, and they're up 49% on a one-year basis. Google has been on a tear in the last year, which has put them at some all-time highs very recently. And despite that, I still think Google is a very undervalued business. Part of that is their cloud services. As that business grows, it just became profitable. As it grows, it's going to only increase their already very high margins. You can see that Google operates at nearly a 30% operating margin. And as Google Cloud Platform is a business with very high operating leverage, each incremental new customer, new revenue is going to lead to just higher margins. That overhead is not going to increase with new customers. And you can see after some of that investment they're making, their margins are back on an upward trend. On a scoring basis, Google has a 3.8 growth score and a 4.13 economic moat score, giving us a total score of 3.93. Over the last 5 years, that has led to a compounded annual return of 26%. I expect that return to actually be higher as the Google Cloud Platform becomes even more profitable. Right now, I have a discounted cash flow price on my base case of $219.03 for Google and at $283.76 for the bull case. This assumes a free cash flow margin of 26% in 10 years on a base case and 28% in 10 years on a bull case. I believe that's easily achievable as not only their Google Cloud Platform becomes more profitable, but their AI investments start to pay off. I'm not even accounting for AI growth in this growth projection. Google just started paying a dividend, and that sent their stock pretty high after their last earnings announcement. Assuming they grow their dividend about 15 to 17% per year, that gives us a dividend discount for the base case at $193.79 and $275.50 for the bull case. That should be an easily achievable number, as their free cash flow payout percentage of their most recent dividend was only 15%. It's very likely they could have dividend growth over the first few years they have this dividend of over 20%. My exit multiple is at $254.80. This assumes just about under a 40 PE for its competitors. Right now, Google has a 27.6 PE and a 25.6 forward PE. At a 20% margin of safety, I still think Google is actually undervalued. They have a $181.14 buy price at 20% margin of safety and a 25.8 forward PE. At a 10% margin of safety, they have a $203.78 buy price. Personally, I'm going to be buying Google up to about $200. I think this stock has an incredible long runway for future growth. They have an incredible economic moat in their search business, and they should only get more profitable as the GCP platform expands. Fourth on this list and our first pure growth stock is Fortinet, ticker FTNT. They close out the day at $58.56. They're pretty much flat on the year and have actually gone down 17% over the last year. They're pretty much flat year to date, but on 1 year basis, they're actually down 17%. But you can see here, this is a very steady growth and earner stock. Their revenue will probably be down a little bit this year, but they're consistently over 20% on a 10-year basis, and their earnings per share has consistently grown over 30% per year over the last 10 years. This is another very capital light business. You can see that down here. Their operating cash has grown very consistently along with the free cash flow because of how capital light they are. They have made some large investments in capital expenditure over the last year that should abate as we move forward here. What they're doing is they're moving more of their business over to the much more profitable services segment of their business. Fortinet is a cybersecurity company. They provide firewall equipment as well as services to IT departments, but the services is really make their high margins. They're using that free cash flow to buy back shares at a nice 2% clip over the last 3 years. And who knows, maybe in a few years they'll start paying a dividend. But speaking on those margins, because they're moving much of their business over to the much more profitable services segment, you can see that these gross and operating margins will only keep going up over time. In fact, I'm projecting their gross margin to get over 80% if they continue growing their services at their current pace. Fortinet is one of the highest scored stocks in my scoring system. They have a growth score of 4.5 and an economic moat score of 4.6. It's a total score of 4.54, and over the last 5 years has led to an incredible 30% return on a compounded annual basis. We should expect that growth to continue as the cybersecurity market is only going to get bigger the more we move into the cloud, as well as Fortinet itself pushing more and more business into its much more profitable services segment. Looking at my valuation summary for Fortinet, I have their discounted cash flow base case at $83.79 and a bull case of $108.56. This assumes a base case free cash flow margin of 31.82%, which is slightly above their current 31.37% free cash flow margin, and a bull case free cash flow margin of just under 36%. Which should be easily doable the more they push business to the services segment. You can also see historically they're quite cheap, a 37.9 PE and a 38.5 PE, both well below their 5 and 10 year averages. Due to the current downswing we've seen in software over the last few weeks, the exit multiple is at $55.23. That's about an average PE of 36. On a 20% margin of safety, I have a buy price at $60.05. So they're even below my 20% margin of safety target. And at a 10% margin of safety, I have a buy price of $67.56. I actually added more Fortinet just yesterday to my portfolio, about 2 shares, and I currently plan on buying up to about $63. I think I'm a little bit more comfortable with about a 15% or above margin of safety. But this business has just a very strong future ahead of it, especially as the cybersecurity market just gets even bigger. And our final stock on today's list is Amazon, ticker AMZN. Amazon closed the day at $189.08. This is a stock I have not talked much about on this channel, and it is actually a stock I just invested in a couple weeks ago. Over $4,000 worth I bought into it at a cost basis of just under $177. It is a stock I've been researching for a while, and I finally decided to pull the trigger. One thing that had been holding me back on Amazon was their less than stellar return on capital and their very choppy free cash flow. However, I realized that that's just part of Amazon's grand plan. And you really have to take a very long-term view with Amazon. Amazon will make massive investments and crush their free cash flow for years. But once those investments pay off, you will see massive growth in Amazon's top and bottom lines. Look at that up here. So in the last 1 year, their cloud services business, AWS, has really started to pay real dividends for Amazon. Their earnings per share increased over 1,000% year over year. Operating income over 200% year over year. This is as they've become incredibly profitable in the AWS segment. But that's just a tiny part of Amazon's nearly $2 trillion business. They're also the world's largest online retailer, and they're synonymous with fast, reliable delivery. Their economic moat and their Amazon Prime business is so wide and so synonymous with online shopping, it's hard to see if that's ever going to be breached in the next 10 to 15 years. But I'm also not talking about their other growth business that has surpassed FedEx and UPS as the largest logistics carrier in the entire world. Amazon is the world's largest logistics business, topping UPS and FedEx. And you can see here that it's only a 22.9% share of Amazon's total revenue. And as more and more third-party sellers come onto Amazon to sell their goods, that logistics revenue is only going to grow. On top of that, Amazon just raised their fees for third-party sellers, further adding more growth to that logistics revenue. You can see here that with the stunning growth of their number one cloud services platform, AWS, and as more and more third-party sellers come onto Amazon, that's only going to push their margins even higher. Retail in general is a very low margin business. That's why their margins actually are sitting at about 17%. A lot lower than some of the other businesses we've talked about. But with the stunning growth of their AWS, these margins should increase phenomenally over time. You can see here that choppy free cash flow margin. Again, this is due to a lot of those large capital investments Amazon loves to make, but Wall Street hates. It's when they make these large capital investments that Amazon's going to dip because Wall Street likes to punish them for that. But it seems to really pay off in the long run for Amazon. Amazon here has a very solid score of 3.7 for the growth and 3.3 for the economic moat. That's a combined score of 3.51, and over the last 5 years has contributed to a 14.6% compounded annual share price return. I haven't done a full in-depth valuation video for Amazon yet. I am going to be doing that over the next couple of weeks. However, my discounted cash flow price for Amazon is at $226.11, and my bull price is at $275.23. Of course, they don't pay a dividend, and I don't have an exit multiple comparison for Amazon because I don't think there's any business out there that really compares to Amazon and gives a reasonable exit multiple comparison. For example, you could use a Netflix for the Prime business, Google or Microsoft for their cloud services business, and a Walmart or Target for the retail business, but all of that just really skews the exit multiple comparison. Despite all that, their PE ratio is at 53, which is in line with their 5-year average, but still below their 10-year average at, 123.8. I think Amazon's an incredibly safe business, so I don't think a 10% margin of safety is out of the question at all. That's a $204.12 buy price target, and at a 20% margin of safety, they're at $181.44 buy price target. Of course, just a few days ago, they were trading around that $180 to $183 range, and decided to really bump up the last couple of days to $189.08. But I'm definitely going to be continuing buying Amazon up to about $204. I think this is a very incredibly solid business. They have an incredibly wide moat and a vast array of economic segments. They're the number one in cloud services, they're the number one online retailer, and they're number one in logistics. They have an incredible future of growth ahead of them. Amazon is a business I really love. I really do wish I invested in them a lot sooner. I was, like I said, scared off by their free cash flow cyclicality, along with their very low return on invested capital. You can see that we're on a trailing 12 basis. It's only 11%. I like businesses with at least a 15% ROIC, but I finally bit the bullet, put some money into Amazon, and I'm going to continue buying Amazon now for the foreseeable future. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.